banks, conventional banks are the number one purchasers of these types of policies. They're not the number one purchasers of term, universal, IULs, variable. No, no, no. They're the number one purchasers of these types of policies designed for this concept. As a matter of fact, conventional banks own more in whole life insurance than all of their land and their buildings combined. As a matter of fact, since 2013, conventional banks have quadrupled the amount of whole life insurance they have purchased. Now, why do you think banks are buying so much in whole life insurance? Is it because they're stupid or they know something the rest of us don't know? That's right. They know something the rest of us don't know.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Brent Kessler. Brent Kessler was a chiropractor, and after implementing the Money Multiplier Method, Brent paid off $984,711 in third-party debt in 39 months. He became so passionate about how powerful this concept was, he began sharing it with others. And in just a minute, we're going to talk with Brent Kessler about infinite banking through the Money Multiplier Method. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe, and as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Brent Kessler. Welcome to CREPN Radio.
Hey, Darren, thanks for having me, man. I'm excited to share with your community today.
Well, I'm delighted to have you, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, just to give you a high level, in my last life, I was a chiropractor. And I guess I still am a chiropractor. I just don't practice chiropractic anymore. I had 5 clinics in the Kansas City area. I actually have not practiced in chiropractic since 2008 myself. However, I sold my last clinic in 2017. And the thing I had like docs in my clinic. I had associate docs in my clinic. And back in 2006, I actually was at a chiropractic conference and I heard this individual on stage speaking about this thing, how to become your own banker, called the infinite banking concept. And I thought it was really powerful information that he was sharing. However, I thought there had to be a catch because it sounded way too good to be true. There's no way it could possibly work the way he was describing. So I took all that information in and I did absolutely nothing with that information. I actually went back home, went back to my normal chiropractic life. And then about 2 years later, Darren, in 2008, I go back to another chiropractic conference. And at that conference, there's about 10 or 12 of my colleagues that were at the previous conference with me. And I guess they had assumed that I heard this information and I implemented it in my life. And so they were coming up to me, they were ranting and raving, going on and on. They were saying, Brent, isn't that banking concept the most powerful thing to pay off debt, to build wealth, to recapture, recycle money, all with just adding one step in your financial life, right? But however, I wasn't doing it. And so anyway, so the thing is they were going on and on about this. So I came home and I told my wife in February of 2008, I said, honey, we have to start implementing this financial concept in our life, right? Because there's no way, Darren, that 10 or 12 of my colleagues could be lying to me. Yeah, so maybe one or two, but not 10 or 12. So I came home and I said, honey, we're going to start this. And it was at that time, February of 2008, I was $984,711 in debt. That's what I owed to the third party creditors. Now, I know what you're thinking. You're thinking, well, Brent, how do you even know, okay, as far as the amount of money that you were in debt? Well, that was part of the exercise. I had to know that. And let me just tell you, that is a painful exercise to go through to really look and see, how deep down the hole you are. Most people won't do it, but again, it was just part of what I had to do. And now you're thinking, well, how are you $1 million in debt? Now I know if you live in a place like probably out in Portland, Oregon, that buys you a very small house. All right. But in Kansas, it buys you a lot of stuff for $1 million. Well, I had my house that I lived in. I had my chiropractic student loans. At the time, I had two clinics. I had a house on the Lake of the Ozarks. And again, that's where I'm coming to you from today, is the Lake of the Ozarks between St. Louis and Kansas City. And obviously, Darren, if you have a lake house, you have to have a boat and a wave runner, don't you? Yeah, man, you can't have a house on the lake without a boat and a wave runner. I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. Well, it didn't take me a lot to become almost $1 million in debt. I was able to apply this concept and I was able to pay that debt off in 39 months, 3 years, 3 months. And all I did, Darren, is I added one simple step in my financial life. In other words, I never had to change my cash flow. I never had to work any harder, take any additional risk, or lose control. I added this one simple step and I became so passionate about it that in 2012, I started teaching this to others. And here we are, fast forward 13 and a half years, almost 14 years later. I've now, I teach this concept all around the country. Over 17,000 members are in our community in every state of the country. I speak on 100 to 120 live events, podcasts, Zoom meetings every single year. So all I do now is I teach people to do the same thing that I have been doing in my financial life.
Wow. Well, your enthusiasm speaks volumes. Your story, I mean, you've got numbers, you've got receipts, you've clearly done it. So for I guess a starting point, we understand you've got debt. We understand you've got your way your money runs. You make money, you spend money. So what is the basics of the internet banking? What's the tool, or how does it work?
Yeah, no, no, actually, great question. Yeah, so yeah, the concept itself has been around for over 250 years, but most people don't understand it because it's not what we're taught about money and finance, right? As a matter of fact, your parents and your grandparents aren't going to teach you this. As a matter of fact, I was mad. I was mad at my parents and grandparents after I learned about this and understood it. And I was mad at them, Darren, because they never shared it with me. But guess why they never shared it with me? Not because they kept it from me, it's because they didn't know. They just didn't know. It's like even your advisors, your financial coaches, your advisors, your CPAs, your attorneys, or whatever, your finance attorneys, they just simply don't know the concept, or if they think they know, they really don't understand it. But the concept has been around for over 250 years. Now, I did not invent or create this concept, obviously, but there's a guy that wrote this book, and it's called Becoming Your Own Banker. And the guy that wrote this book, his name is R. Nelson Nash. Now, Nelson was my mentor. Now, R. Nelson Nash, he passed away 6.5 years ago at age 87. And anyways, okay, so Nelson completely changed my financial life. And again, this book, Becoming Your Own Banker, changed my financial life. So the thing I'm going to recommend to everybody in your community in the sound of my voice today is go find that book. Wherever you buy books at, go find this book, Becoming Your Own Banker, buy it and add it to your wealth building library. And if you're like me and have a little ADD going on, and you don't like to read, you can also get a couple hours of audio with it as well. So I definitely recommend that you do that. Now, I wrote another book called Mapping Out the Millionaire Mystery about 5 years ago. Now, I'm going to offer this book to all of your listeners. All you can, the thing, just go to our website, themoneymultiplier.com, and you can download the ebook there, have the ebook sent to you. Okay, because there's no sense in buying this book. Just get the ebook version. You can print it out. Now, also, I wrote this book with a guy named Chris Naugle. Why is Chris Naugle important? Well, Chris Naugle, right? So the thing is, he started out as a client of mine. He's now a colleague. But Chris is very, very active in the real estate world. And I know the majority of your listeners are probably they're in the real estate world. Well, Chris had a couple TV shows. He had one on House Hunters, another one on HGTV called Risky Builders. So if you don't know anything about Chris Naugle, just go out there to chrisnaugle.com and check him out. He does podcasts and he talks about this concept that I teach as well. He lives in Buffalo, New York. It's Naugle, Naugle. So the concept that you asked me, the question that you asked me is, what is the tool, what is the vehicle that we're going to use to build, keep, and create wealth? Now, I'm going to share that with you in just a minute, Darren. But before I do, I'm going to warn you, and I'm going to warn the listeners that once I tell you what this product is that we're going to use to build, keep, and create wealth, about half of you are going to totally shut down. I don't know how you're watching us today, but what you're going to do is you're going to turn everything off and you're going to say, you know what? I got better things to do with my day. I've heard about this before. There's no way this product can work that way to build wealth. And you guys are going to go out and say, you know what? I'm not watching this anymore. I'm going to watch my favorite TV show, or you're going to burp the baby, wash the dishes, walk the dog, or whatever. But let me just tell you, before you make the decision to turn me off after you hear what it is, keep an open mind, because I can assure you, you don't know everything about there is to know about this concept. Because remember, it took me 2 years. I thought it was too good to be true when I first heard about this concept, right? It took me 2 years to start this in my own life, and now I teach it. So here's the product that we're going to use to build, keep, and create wealth. Are you ready for it? Here it comes. The product is a whole life insurance policy in a mutual company that pays dividends, that is specifically designed for high immediate cash value. Now, I just said those bad words, Darren, and that's where I lost the viewers, because I said life insurance. And here's what the audience is thinking right now. And how do I know what the audience is thinking now? Because I do 100 to 120 of these a year, and I see people, and when I'm standing on stage in front of people, I see them shut down as soon as I say the word life insurance, right? So the thing you're thinking is, how on earth are we ever going to build, keep, and create wealth with a life insurance? You're thinking, I know everything there is to know, or most stuff there is to know about life insurance, and that would be a horrible idea to build wealth using life insurance. Well, as a matter of fact, that's what Dave Ramsey and Susie Orman say, don't they? They say life insurance is a bad idea to build, keep, and create wealth. Well, let me be clear. You don't know everything there is to know about it, because if you did, you would be implementing this in your own life. And if you and again, okay, I want to be clear that this is not any type of life insurance. This is not the life insurance policy that you can go buy from your brother-in-law that sells life insurance. No, 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 right? Because we all have a brother-in-law that sells life insurance, don't we? It's not that policy. It's not a term policy. It's not a variable. It's not a universal. It's not an IUL, an index universal, an index policy. No, no, no. This is a specifically designed, specially engineered whole life insurance policy in a mutual company, very important, in a mutual company that is specifically designed for high immediate cash value. One more time, high immediate cash value. So, what that means, Darren, is when you put money into this policy, you immediately, now my definition from here on out, and everybody that knows me, when I say the word immediately, I mean within 30 days. So when you put money into this policy immediately, AKA within 30 days, you have cash value to access in this policy to use for anything in your life that you want to buy. It could be a boat, a house, a TV, a car. It could be an investment into real estate, college education, a tank of gas. Whatever it is that you're exchanging money for, you now are able to access this money to use it for anything that you want to purchase. Now, let me say this. Banks, conventional banks are the number one purchasers of these types of policies. They're not the number one purchasers of term, universal, IULs, variable. No, no, no. They're the number one purchasers of these types of policies designed for this concept. As a matter of fact, conventional banks own more in whole life insurance than all of their land and their buildings combined. As a matter of fact, since 2013, conventional banks have quadrupled the amount of whole life insurance they have purchased. Now, why do you think banks are buying so much in whole life insurance? Is it because they're stupid or they know something the rest of us don't know? That's right. They know something the rest of us don't know. So all we're going to do, Darren, is we're going to mimic and imitate what the wealthy have been doing for over 250 years. Now I know what a few of you are thinking. You're thinking, well, Brent, I hear your flapping lips and your gums are moving that you're telling me this, but how do I really know that's true? Don't take my word for it. Go out and Google something called BOLI, BOLI. It stands for Bank Owned Life Insurance, and you will see the hundreds of pages that come up on how much life insurance conventional banks actually own. And who's doing this? The wealthy are doing this. Look, go research the wealthy and see how they build, keep, and create wealth. In other words, I want you to go research like just people like the Rockefellers, the Rothschilds, the Morgans, the Stanleys, the Barclays. Go research how Walt Disney built Disneyland, how Ray Kroc funded McDonald's, how Pampered Chef got started before Warren Buffett purchased Pampered Chef. Look at the common denominator and what the tool was that they used to build, keep, and create wealth. So all we're doing, Darren, is I'm not going to reinvent. I'm not going to reinvent the tools that the wealthy have been using for over 200 years. I'm just going to use those tools and build, keep, and create wealth with them. And that's what I've been doing over the last, well, since 2008.
Got it. So the secret's out. It's life insurance, but it's not just any life insurance policy. It's a specific, you said whole life in a mutual company that provides instant or pays dividends, and it has immediate cash value. Are those basic? Did I get that right?
Absolutely. And a key word in that is immediate cash value, aka within 30 days. And another key word of that is a mutual. Why is mutual important? Because in a mutual company, there are no shareholders or stockholders, right? You own the policy contract, not the insurance company, right? You own the policy contract. And what that means is you are earning the profits and the dividends on that contract. Now, even though the insurance company is never guaranteed to pay a dividend, you still have a guaranteed growth rate inside of the policy that grows internally, tax free also. Okay, I won't even go there yet, but it's growing tax free. but then you have a projected amount they're going to pay in a dividend. Is the dividend guaranteed? No. But every insurance company that I use has been paying dividends for well over 123 consecutive years without fail. But let's just hypothetically assume that they stop paying dividends, which I don't think they ever will, not during my lifetime or your lifetime. But let's say they did. Okay, so they stop paying the dividend, but it never goes back to where they're not doing the contractually obligated growth that's in the policy contract. As a matter of fact, Darren, what you and your viewers can do is go out and look. And I want you to go out and look, and I want you to find me anybody that's ever lost money in a whole life insurance policy in a mutual company that pays dividends. You won't find one. You won't find one because the insurance company is contractually regulated to do what they're just to do in their contract. And furthermore, they're not federally regulated, they're state regulated. And what's even more important is insurance companies cannot use what we call fractional reserve banking. You see, a bank can loan money that they don't even have, right? Banks can loan 8 to 10 to $12 for every dollar they have on hand. So let's say we all went to the bank at the same time. We all made a run to the bank. All of us went to the bank at the same time to get our money out of the bank. Guess how much you would get? Maybe 7, 8, or 9 cents of every dollar that you have in there because the banks physically don't have the money. All that FDIC bullcrap that you read about, that would go right out of the window. In an insurance company, they can't do that. $1 has to protect $1 because what they do is they go something along the lines of what you call Austrian economics, where in Austrian economics, $1 has to protect $1.
Got it. So we've established that it's a life insurance policy. I mean, a specific type of life insurance policy. Tell us, so the mechanics. You buy a policy, the face amount determines the cost typically. If you buy $1 million policy versus $100,000 policy, that typically is tied to you as far as your age, any kind of physical they might do to get to determine the premium. Once that's established, do you overfund the policy? How do you do it so that the money, because what we've talked about is, you said you do nothing different than you would have done normally except this one step.
Yeah.
You buy the policy, if you pay it just whatever the premium that they're asking for, I'm assuming you're not going to get, huge opportunities for additional money. Tell me a little bit about the mechanics of the
Yep, great
internet.
question. And the thing, all right. So the thing I'm going to do is give you the 25,000 foot
Yep.
view. However, if you go to our website, themoneymultiplier.com, I have a full 90+ minute recorded presentation on there that goes through the details of it. It goes through examples, and it's all that stuff. All the details and examples are on there where you can download them and print them off. A full 90+ minute presentation on the website, themoneymultiplier.com. Now, great question of what you're asking, and it's almost completely the opposite of how we approach it, because again, so the majority of people think when you're going to buy life insurance, you're like, okay, how much is the life insurance going to cost me for X amount of death benefit? We never ask any client, how much death benefit do you want? We ask you, how much cash do you want to put in the policy? Okay. So you determine the amount of money that you want to put in the policy. You determine how often you want to put that in. You determine if you want to lower it, stop it, whatever you want to do. You are in control of that amount. Now, I have clients that put in as low as $60 a month, and my biggest client puts in about $540,000 a month. Now, you pick a number in between there that you want to put in. You can do it monthly, quarterly, twice a year, annually. You can always lower it. You can change the mode of how you're paying it. Okay. But the thing that you're going to do is you're going to decide the dollar amount that you want to put in. And when you put that dollar amount in, it's going to buy you X amount of death benefit based on your age and your health. So I'm not solving your need for death benefit. I'm solving your need for cash and finance. As long as I solve your need for cash and finance, you'll have more death benefit than you can ever imagine. Now, I want to give you an example of this because it's important. Let's just say both of us are twins, okay? You and I are twins. Now, I know you're a lot younger than I am. At least you look a lot younger than me. But let's just say both of us are twins, okay? We're twin brothers. But you are an Olympic athlete and I am an overweight tobacco smoker, okay? And we both go in and we want to put in $10,000 into a life insurance policy. It doesn't matter what the amount is. Let's just say it's $10,000 or $1,000 a month or $100 a month, right? And we both do that. We're twins, so we're the same age. Well, who's going to have the most cash value? I'm sorry, who's going to have the most death benefit in their policy? Because we're both paying the same amount of premium. It's going to be you because you're the Olympic athlete, not me. I'm the overweight tobacco smoker. So my death benefit is going to be lower than yours. But the cash value is going to be equal. It's going to be so close to equal that we don't even talk about the differences. That's how close it is, right? So it doesn't matter about your age and your health when we're talking about cash value in the policy. The only thing that's affected is the death benefit. Now, every policy has a death benefit on it, which is a great thing. Now, the cool thing about it is the cash value constantly increases in the policy and the death benefit constantly increases in the policy. It does it all the time. It's always, always, always 100% of the time. It's not my flapping gums telling you that. It's in your insurance contract. So before you ever sign, pay for your policy, accept your policy, you want to look at the contract and you want to make sure the cash value is going up and the death benefit is going up on those policies. Even if it never pays a dividend, you want to see that it's still continuing to go up. And it does. And the thing that we're doing is we're using that cash value to use it for anything that we're buying in life while we're keeping the death benefit and it's continuing to rise. Now, anytime you take money from your policy, the cash value, anytime you take cash value from your policy, it could be $1, it could be $100, $1,000, $1 million, depending on what your cash value is on the policy. Anytime you take that money out of the policy to go buy the stuff that you're going to buy in life anyway, pay your debts and expenses, invest in real estate, whatever it is, you are not taking the money actually out of your policy, which this is a great thing. So what you're doing, Darren, is you're putting your policy up for collateral. You're simply taking a loan from the general fund of the insurance company. So all your money is still in the policy. It's compounding and growing in that guaranteed tax-free growth rate environment. So you're using your money, but all of your money is still in there growing and compounding. So essentially you're double dipping on your money. Now I have other videos out there that talk about double dipping on your money. And guess what happens when you're using the money, which is not your money you're using the insurance company's money. So essentially what we're doing is we are using a portion of our death benefit while we're living. That's really what we're doing. A loan is simply a prepayment of your death benefit, right? Because the death benefit's always going to be there. The death benefit is guaranteed to pay out when you die, passing, or graduate, right? It doesn't matter whatever word you like to use. It's not an if, it's a when. So when we're using a portion of the death benefit while you were living, Isn't that a lot better than you just buying life insurance, building up a death benefit, and then when you die, all the money goes to your ungrateful children? Or am I the only one that has ungrateful children? You're using the death benefit while you're living, which is huge.
So let me ask you this. You've got a policy. We've already talked about the face amount's not important. It's more about, building cash value. Are there any limitations on how much you can borrow in relation to the cash value of your policy?
Yeah, there are limitations. It depends on where you're at in your policy. I own 29 of these policies. The first, and again, I start one about every 1 to 2 years. And just as far as the high level, people are asking, well, why would you start more policies? Why don't you just keep one? Because each policy is a contract, and I can't overfill the contract. Like if this is 10 ounces right, let's say this is 10 ounces of water. I can't put 12 ounces of water in it. It won't hold it. Because, see, back in 1988, there was this thing that called the MEC rules. MEC, it stands for Modified Endowment Contract. Now, our government put that into effect. Why did they put that into effect? Because people were stuffing all this money in their policies. And then, of course, anything that's working good for the people, the government says, hey, let me come in there and see if we can get a piece of that and how we can do that. So they came in and they created this thing called the MEC environment, which says you can't overfill your policy, because if you do, it'll no longer be treated as an insurance contract. It'll be treated as an investment, and it's subject to taxation. So you can't overfill it. So that's why we have to do other policies. So the thing that we're doing is trying to get as much money into this system as we possibly can. Even in Nelson's book here on Becoming Your Own Banker on page 48, he even says eventually you want your premium to equal your income. So because every dollar you make is a deposit into somebody else's account. And what you want is all those dollars going into your account where you control them and there's no money being leaked out to others. It stays within your family. You have an internal growth rate inside of the policy. It's not being leaked out. And you have the government that's completely out of your hair, because they're not in your hair, because the internal growth of your policy is not taxed. The internal growth of your policy is not taxed. And when you take a loan from your policy, keyword here, loan, not withdrawal, a loan is never taxed. You've never paid tax on a loan. The only way it would be taxed is if you would withdraw, keyword withdrawal, which you don't want to do, if you would withdraw above and beyond cost basis, but you want to keep it as policy loans. And eventually, when the policy comes to an end, which the end point will be when the insured dies, passes, or graduates, whatever word you like to use, and then the death benefit goes to your beneficiary tax free. So the government is out of your hair and you've only paid tax one time on your money. I guess we should have started with that, Darren, because if your viewers, anybody that's on here listening today, if they like big government control, then they probably aren't going to like this concept.
No, that's fascinating.
And
How
I'm
the
sorry, but I forgot the question you asked me.
no. You were asked, or you were talking about how much you could. I was asking about, what's the maximum you can borrow
Oh,
in
okay.
relation
Yes,
to the
please.
balance.
I forgot. I didn't want to avoid that. It all depends on how we structure the policy. Now, the policy gets structured the way that you want it to be structured, right? And of course, a policy is not for everybody. Yeah, I mean, it's great to have one of these, but not everybody can have a policy. Not everybody can be insured. So you have to qualify for this type of policy. In other words, you have to be insurable. Okay. So, but the thing is, so let's say you're not insurable. We have people that own policies that aren't insurable. I will tell you, I'm age 58 right now, and at age 58, Of course, I'm insurable. We have people that are insurable up until their late 80s. They can get policies on their bodies. Now, me right now, I am not insurable because I have some health challenges going on. So I could not go today to get a policy. Now I have policies on my body, but I've probably been insurable for about 2 years. Now, is that always going to be that way? I hope not. I hope I can get more policies, but I still buy policies every year. Who do I buy them on? I buy them on other people that I have a vested interest in, such as family members or people that are in my business that I have a vested interest in. For example, right back when I owned chiropractic clinics, I bought policies on my chiropractors that were my associate docs. And I own those policies today. Even though I have nothing to do with those people, I either sold them, okay, just the clinic they were in, or they went a separate way. I still own those policies. And why were they an insurable interest? Well, at that time, they were an insurable interest to me because if they don't show up to work and treat the patients, or something happens to them, if they die or pass, I have to find someone to replace them and my income goes down. So you can own policies on other people. And again, so all right, so like the majority of people, they either started on their family members, such as their spouse, children, grandchildren, or they do it on their key employees, maybe at their company, right? Now, how much cash value can you have on a policy? Well, my oldest policy, and again, here's where I was going with that before. My oldest policy, I started in 2008. So I've paid about 17 years into that policy so far. In the very first year, the way I designed that policy, the very first year back in 2008, so when I put in $1 into that policy, I had access to about around 55 cents of that dollar. Now I know what you're thinking. That sucks, Brent. 55 cents a dollar. I get it. I get it, but you got to understand the whole picture. Today, I put in $1 into that policy and I have access to almost $2.60 for every dollar. That means if I put in $100,000 this year, I would be able to use 260,000 as long as the policy will hold that amount of money because the numbers go up each and every year. Now, that's not the way you have to create a policy. And I'm not saying that's the best way that I created my very first policy. But the answer to your question that everybody's asking, including you, how much cash can you access right away? And that number can be as high as 94 cents of every dollar. So you can put in $1 today and you can access immediately within 30 days up to 94 cents of that dollar. Now, there's pros and cons to accessing more earlier, as opposed to accessing as opposed to accessing a little less earlier. There's no right or wrong about it. It's not a right way or a wrong way. It depends on you and where you're at as an individual and where your financial needs are. But keep in mind, in all of those scenarios, the dollar that you put in, it doesn't matter whether you access 55 cents of the dollar or you access 94 cents of the dollar is your money. It's all your money. It's just how much you can access immediately, AKA within 30 days.
Got it. So you take it's a loan. Is that right? Am I saying that right?
It
Policy
is.
loan. Okay.
And I know that's probably got some people hung up too. I'm going to remind you, go to my presentation, themoneymultiplier.com. I go over the loan method of how this works in nauseating detail. As a matter of fact, I show you on there, I give you an example, and most people don't understand this, even in the real estate world. They don't understand how they can borrow at a higher interest rate than what they're earning and make money all day long. As a matter of fact, I show you how to borrow at 6% and earn 4%, and you're going to make money doing that. Most people think if I borrow at 6 and I earn 4, I'm losing 2. No, that's not how money works. It's not how it works if you've got the steps in place. I show people how to borrow at 20 and only earn 10. What? I borrow at 20 and earn 10. That means I'm losing 10. That's not how most people, but no, you actually make money if you borrow at 20 and earn 10. It's all the motion and the flow of money and where the money is staying at, which is very, very important.
Got it. Well, I'll encourage all the listeners to go to your website there and check that out for the to see the exact how it works and how the money compounds and how you can borrow and repay and make that money work for you. That's great. Hey, Brent, if we could, I'd like to shift gears here for a second.
Sure.
As I mentioned to you before we started, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, the market, the Fed, the political environment, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Brent Kessler, what is the biggest risk?
Yeah, well, let me answer it a couple different ways on there. But so as far as a risk, okay, as far as in our business and what we do when you have this type of policy, I tell people all the time there is no risk at all because nobody's ever lost money in a whole life insurance policy. But then I stop and I say, wait a minute, there is one risk. The risk is you. The risk is you, the client, and how you use the policy. So you're the only one that can screw this up. You are the only one that can screw this up. The insurance company is not going to screw it up. So who do you know better than you? So you're the risk factor. Now, as far as a risk, also when I because again I invest in properties. I have short-term rentals, long-term rentals, Airbnbs, VRBOs. I have raw land, and I do a lot of private lending in the real estate world. I lend to individuals for houses, even to cars, and I also lend into big property developments and to big communities, to real estate developers, where I'm providing a portion of their financing to build these big developments. Like we got one right now going in Covington, Georgia, another one in Fort Collins, Colorado, where these are big housing projects, right? Well, look, I've been doing this quite a long time, and I've learned a lot as I've gone through this. And the one thing I've done to really lower the risk, because anytime you invest money, you are assuming some sort of a risk. Okay. So that's why the insurance policy that I talk about is just like not an investment because you can't lose money. See, an investment, it can go up or it could go down, right? So there's a risk involved. But I would say to avoid risk at your greatest right, just as far as especially as far as in the real estate world, is to be in first position in everything that you do. Be in first position. How do I know that? Well, I've been in second position. Did it always work out? No. As a matter of fact, and I guess if I would have known you were going to ask me this question, I would have wore this shirt that I have, and it says, if you're not first, you're last. That's what my t-shirt says. If you're not first, you're last. So I protect myself by being in first position, and I want the collateral on any money that I'm loaning. I want that collateral to be, I want that collateral to be at least equal to, if not greater than the loan amount that I'm actually loaning. Now, I might have to spend some time and energy going out and chasing down and trying to get that or get the collateral, which is going to be a pain in the butt, but you would much rather have the collateral than not have it. One more thing I want to point out from my own personal experience. A couple years ago, we experienced Hurricane Ian. Part of my portfolio of rental property is in Captiva Island, Florida, North Captiva, Florida. I own a property. If you go out and you take a look at it just for a rental, it's called CaptivaBeachSunset.com. Beautiful property, sits right on the Gulf of Mexico. It sleeps 18 people. It's all short-term rental. It gets about 350,000 a year in annual rental. Um, I paid back in 21, I paid 1,760,000 for the property. I'm about to sell it. I'm about to sell it for a very discounted rate because I'm selling it to my son, who is a property manager, and he's buying it for $2.4 million in January. He's getting a great discounted rate. Even though I paid 1.7, selling it for 2.4, I did okay, got all the rental income. On top of that, when Hurricane Ian came through, I had insurance on the property. It didn't flood, but it had wind damage. And let me just tell you, if you live in Florida, you guys know you probably don't even want to buy flood insurance because it's so expensive, and if it and it does, and it's a lot of limitations of what it covers. But I had wind insurance on that property. It took me a while, but I almost got $1 million on my insurance claim from the damage on that property. Now, a lot of people think, wow, $1 million, you got $1 million from the property. Well, that property was shut down for about 2 years, which means it couldn't be rented. I had to do all the renovations, had to pay for that, had to pay for that all out of pocket because it took a while for the insurance company to pay on that property. So did I really make money? No, I didn't make money. I did okay, but I didn't make money because I lost all that rental income. But I do think my lucky stars that I had insurance on that property, because if not, I would have taken all of that hit.
Got it. Well, Brent, I can't say, or actually, let me ask you this: where can the listeners go if they'd like to learn more or connect with you?
Yeah. And again, guys, everything I tell you, please don't take my word for it. Don't take me as telling you the gospel or the truth about money and how money works. Go out and I want you to Google us. Go Google the Money Multiplier. Go Google my name, Brent Kessler with one S. Go look and see what other people say about us. Look at our plan designs, our case studies, our success stories, our testimonials. There's no way that many people that are out there telling testimonials about how we've helped them financially. There's no way they could all be lying. But the way you can find us is go to our website, themoneymultiplier.com. THE, the word money, multiplier.com. Or you can send me an email, Brent at themoneymultiplier.com. I'm happy to send you the book that I wrote. I'll just send you the ebook version, Mapping Out the Millionaire Mystery. You can go on our website and watch that 90+ minute presentation. I've got over 70 other short videos. And if you like watching podcasts, go watch my daughter. She has the Money Multiplier podcast. As a matter of fact, Darren, you and her should exchange podcasts. She has over 137 episodes. She's 26 years old. She teaches and practices this concept all around the country, just like I do. She records a new podcast episode every week. I think she's at about 137 right now. So go watch and learn from that as well.
Awesome. Well, Brent Kessler, I can't say thanks enough for taking the time to talk today. I've enjoyed it. I've learned a lot, and look forward to doing it again soon.
Hey, thanks, Darren. I think we should have a part 2 sometime because there's so much more to go over. But again, thanks for having me on and allowing me to share with your community.
You got it. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.